Silver prices are lying to you because the market you see on your screen is no longer the market that actually exists. In theory, global prices move together. If silver spikes in one place, it should instantly rebalance everywhere else. That's how modern markets are supposed to work. But right now, that rule is breaking in real time. In China, buyers are paying over $100 an ounce for physical silver. In the United States, the official price is dramatically lower. That gap isn't closing, it's growing. And that creates a contradiction that should not be possible in a functioning system. Here's why this isn't just a trader problem. If price no longer guarantees access, then money doesn't buy certainty anymore. It buys delay, it buys excuses, and sometimes it buys nothing at all. If you can't take delivery, the price is just a suggestion. But here's the part nobody is saying out loud. When a market stops enforcing reality, it doesn't fail quietly. It spreads. Because if silver can break first, something else is already next. What you're watching isn't a random spike, it's a pattern forming in plain sight. The trigger looks simple on the surface. Silver prices in Asia disconnect, Western prices lag, traders argue about charts, but that framing misses what's actually happening. This isn't volatility, it's fragmentation. Two markets claiming to price the same metal are no longer agreeing on what that metal is worth or even how available it is. Officially, everything is fine, contracts still trade, screens still update, but notice what's missing from the reassurance. Nobody is saying delivery is easy. Nobody is saying inventories are comfortable. Nobody is saying this gap will close on its own. Instead, institutions quietly slow sales. Retailers quietly limit quantities. And buyers quietly change their behavior from speculation to accumulation. That's not how confidence looks. That's how systems behave when participants stop trusting the mechanism and start trusting their instincts. Here's the reframing question that changes everything. Is this really about silver prices going up, or is it about the pricing system losing its authority? Because once people stop believing the price guarantees access, the entire structure above that price becomes fragile. And that fragility is exactly where the next escalation begins. The claim sounds extreme, but the evidence keeps stacking in the same direction. The Western silver market is running on paper promises it can't easily honor. One concrete signal exposes that pressure. A US government mint abruptly halted sales of its silver products. The public explanation was administrative, a need to reassess pricing. But here's what matters more than the wording. When a national mint stops selling silver during a price surge, it's admitting that replacing inventory at current prices no longer makes sense. In other words, selling metal has become riskier than not selling at all. That's not how a healthy supply chain behaves. In a functioning market, higher prices attract more supply. Here, higher prices are pushing suppliers to step back. Some private dealers are doing the same thing, delaying shipments, limiting orders, or simply refusing to sell at posted prices. Notice what they didn't deny. They didn't say silver was abundant. They didn't say supply was stable. They didn't say this was temporary. Instead, they changed the rules of access. And that's the tell. When institutions stop trusting their own pricing models, the problem isn't demand. It's confidence in the system that sets the price. Now watch how fast this escalates, because the pressure doesn't stay contained at the top. Once access starts tightening, normalization kicks in fast. What would have been unthinkable a few years ago suddenly becomes routine. Limited quantities, delayed fulfillment, check back later. Not because demand exploded overnight, but because the system can't absorb stress the way it used to. This is how escalation actually looks in modern markets. Quiet, procedural, almost polite. We've seen versions of this before. Not with silver specifically, but with anything that transitions from abundance to strategic importance. Energy, semiconductors, shipping capacity. The early phase always looks manageable, small restrictions, temporary measures. then those measures stop being temporary. Here's the dangerous part. Once rationing becomes normal, price stops doing its job. Instead of balancing supply and demand, it becomes a signal of scarcity. People don't buy because it's cheap. They buy because they're afraid it won't be there tomorrow. That's when behavior flips. Buyers stop asking, is this a good price? And start asking, can I still get it? And sellers stop asking how much they can sell and start asking whether they should sell at all. This is where the story flips. Because when markets move from pricing risk to managing fear, the old rules don't apply anymore. And the next piece of evidence makes that painfully clear. The second proof is more unsettling because it exposes a contradiction you're not supposed to notice. As prices accelerated, the exchanges didn't step back and let the market clear. They stepped in and made trading more expensive. Margin requirements were raised in a way that scales automatically with price. That means every dollar increase doesn't just raise the value of silver. It raises the cost of holding it instantly, continuously. On paper, this is about risk management. In reality, it functions as a pressure valve designed to force participants out. Smaller players get squeezed first. Positions get liquidated, not because they were wrong, but because they became unaffordable to maintain. Here's the contradiction. If the market were genuinely overspeculated, these measures would cool prices. They didn't. Prices kept climbing anyway. That tells you something critical. The demand driving this move isn't easily scared. It's not leveraged in the usual way. It doesn't disappear when conditions tighten, because a growing share of that demand isn't chasing price, it's chasing possession. Here's why that detail changes everything. Financial tools can suppress speculation. They cannot create metal, and they cannot stop buyers who are willing to pay whatever it takes to secure physical supply. When a market resists its own brakes, it's telling you the force underneath is stronger than the system designed to contain it. And that's when instability stops being theoretical. Now the pressure starts stacking faster than the system can respond. Multiple stress points hit at once. Retail demand surges and doesn't cool. Institutional sellers pull back instead of stepping in. Exchanges tighten rules, but prices refuse to slow. Each response creates a new problem somewhere else. That's what loss of control actually looks like. Not a crash, a feedback loop. At the same time, geopolitical tension bleeds into markets. Instability isn't abstract anymore. It's headlines, sanctions, threats, and credibility questions aimed at institutions that used to anchor confidence. When people start doubting whether policymakers are in control, they don't wait for confirmation. They reposition, add one more layer. Central banks and large players quietly reduce exposure to paper promises and increase exposure to things that don't rely on trust. That shift doesn't announce itself. It happens in flows, in allocations, in silence. Notice the speed. None of this unfolds over years. It compresses into months, then weeks. The market doesn't get time to adapt. It gets forced to react. So here's the question that matters now. What happens if this continues? If demand stays physical, if supply stays constrained, and if confidence keeps leaking out of the pricing system itself? Because at that point, the damage stops being contained to traders. This is the point where it stops being abstract and starts showing up in everyday life. You don't experience this as a chart, you experience it as friction. Longer wait times, fewer options, higher premiums that don't make sense compared to the official price. You're told supply exists, but somehow it's never available when you try to act. And it's not just silver buyers, this kind of breakdown leaks outward. When pricing systems lose credibility in one corner, people start questioning others. Savings, retirement accounts, anything that depends on promises being honored later. The effect isn't panic, it's quiet adaptation. People change behavior without announcing it. They hold instead of trade. They delay selling. They prioritize control over return. That shift is subtle, but it compounds fast, because once enough people behave this way, liquidity thins, and when liquidity thins, shocks travel further. If this feels familiar, say so in the comments. Not because you're predicting collapse, but because you recognize the pattern. Systems don't fail all at once. They fail by becoming less useful at the margins. And when enough margins erode, the center can't hold. Which leads to the deeper question. How does a system designed for infinite paper claims end up colliding with finite physical reality? The answer isn't corruption or incompetence, it's incentives. Modern markets are built to reward scale, speed, and leverage. Paper contracts are efficient because they can be created instantly, traded endlessly, and settled without moving anything physical. For years, that efficiency worked because very few people asked for delivery at the same time. But that efficiency hides a fragility. The system assumes most participants will accept cash settlement, roll contracts forward, or exit positions before anything real is required. It's a confidence game. As long as trust holds, the structure stands. Here's the unsettling insight. The moment a critical mass decides they want the thing instead of the promise, the math breaks, not because of malice, but because the system was never designed for universal redemption. Fear accelerates that realization, spectacle amplifies it, and incentives push institutions to protect the structure rather than admit its limits. That's why you see rule changes instead of transparency, friction instead of clarity. This is why the story feels different from a normal commodity cycle. It's not just supply and demand, it's a stress test of whether abstract systems can still command belief when reality pushes back, and once belief cracks, the future stops being linear. From here, the path splits and neither direction is comfortable. One possibility is controlled adjustment. Prices continue rising, but in steps. Rules keep changing, access tightens quietly, the system stretches, absorbs pressure, and tries to re-anchor confidence without admitting what broke. On the surface, it looks stable. Underneath, participation narrows to those who can afford friction, delays, and uncertainty. The other path is faster and messier. A shock hits, maybe supply fails, maybe delivery expectations shift, maybe one promise gets tested publicly. If that happens, repricing doesn't wait for permission, it jumps. Not because fundamentals changed overnight, but because belief did. Notice what's already forming. Physical demand doesn't retreat on pullbacks, it strengthens. Institutional behavior doesn't reassure, it hedges. And pricing mechanisms don't simplify, they add complexity, which is often a signal of strain, not strength. Uncertainty is the common thread. Nobody knows exactly when the next move comes, but momentum is building in one direction, toward ownership over exposure, toward control over convenience. The next move may not be dramatic on camera, but it will be decisive in hindsight, because once that line is crossed, there's no easy way back to how this used to work. Here's the insight that ties all of this together. This isn't really a story about silver going up. It's a story about what happens when reality reasserts itself inside systems built on abstraction. For a long time, trust made paper behave like metal. Now metal is reminding everyone what trust was covering up. When price, access, and confidence move together, markets feel boring. When they separate, everything changes. The number stops being the truth. It becomes a signal, sometimes a warning. What you're watching now is that separation happening in slow motion, not with sirens or crashes, but with gaps, delays, and rule changes that most people won't notice until later. By the time it's obvious, the adjustment is already done. This is why these moments matter, not because they guarantee an outcome, but because they reveal how systems behave under stress. And once you've seen that behavior, you start recognizing it elsewhere. If you want to keep tracking how these fractures spread and what they mean next, follow the channel. The next layer of this story is already forming.